Our headline today comes to us from the Wall Street Journal. This is written by Kane Otani. People wonder when stocks are going to bottom out. Well, guess what? This piece went and took a look and said stocks historically don't bottom out until the Fed eases up. Another week of whipsaw stock trading has many investors wondering how much further the market's going to fall. If history's any guide, sell-off might still be in its early stages, this piece says. More doom and gloom for the Wall Street Journal, OG. Looks like until the Fed eases up, we might be in trouble.
Well, I don't know that we're in the early stages. Minus 20 something in the S&P, give or take. Seems a lot like mid stages, but you know, who knows? Who knows? Nobody knows. That's the fun thing about this.
I think it's frustrating to me about this recession, right? Is that so many things are different. I mean, recessions usually
not a recession
come with,
yet. Not a recession yet. You can't use the R word.
As we record this, but 2 weeks from now when it comes out, I think we can agree that it's a recession. I have yet to hear one guru say, probably not going to be a recession.
Yeah, what's the definition? You got to have 2 consecutive quarters of negative GDP. I mean, I don't know.
But aren't we getting that call by the day this comes out? I think we.
What do I know?
I think we are.
I'm just a podcaster.
Who knows? Anyway,
it feels like it. It smells like it, and it looks like it. It's probably a
let's use the word recession. But how many of these recessionary times, whether it's a recession or not, how about that? Like recessionist qualities come with a job boom, right? Where people are getting not only paid more money, but we're seeking out workers left and right. Like every recession that I've known my life and then have studied from before I was alive, all those came with massive layoffs. It's a whole different ballgame this time.
Yeah, this is kind of a weird thing, you know, where unemployment is really low. There's more jobs being offered than there are people to fill them. The housing market is obviously slowing down in various places throughout the country. Interest rates are higher. I read something over about, 10 days ago or so that said the interest rate changed going from 2.5% to 6%, which is where the 30-year rate was just 6 months ago. Now is above 6%, has changed the availability of the market in terms of the people who can afford $400,000 houses by 18 million households. 18 million fewer households are able to afford a $400,000 house. So you got to imagine that's going to have some pressure on house prices. If nothing else, is going to flatline for a while. But yet in some areas, I live in Dallas, there's nary a breath of housing issues. There's still more people moving and it's just weird.
Had a discussion with Paula Pant about that over on the Afford Anything podcast, OG, and she believes from the things she's reading that it just changes the nature of who the buyer is. So even though there's fewer buyers there, you now have a different type of buyer that's coming in and purchasing. Like as an example, Goldman Sachs, you might have read a few weeks ago, bought a whole damn neighborhood, I think in Arizona, just came in. And now you have, as some people start to falter with their mortgages, you have other people with very strong financials coming in and swooping in before prices go down. So she actually believes.
But I'm not, are we seeing people that are having issues with their mortgages yet? I don't think so.
Not yet. I think we're at the leading edge, which scares me. When we talked to people like Charlie Wise a couple of weeks ago from TransUnion saying we're just starting to see people start to struggle, but it's on the consumer
debt side where interest rates can change. The vast majority of consumers right now are holding those 15 and 30-year mortgages at 2 or 2.5 or 3 or 3.5%.
That's true.
I mean, there's a lot of people who are looking at it going, oh, thank God I got this. Now the new buyer, the person who's coming in, and the issue with, Goldman Sachs buying up properties is their timeline is forever. They're not interested in flipping it. Right. So that house is, or in that case, that neighborhood is gone from the market forever. Like that will never be sold again, or if it does, it's packaged up and sold. Although, to be honest, I got a feeling that this is the, whatever du jour, and those Johnny come latelys of I'm going to go buy a neighborhood in Scottsdale because I've got hedge fund money and there's nothing else to do with it right now. I also saw something that Open Door, which is a company that's kind of like a Zillow or something like that, one of these real estate companies, they now have some obscene amount. They own 4% of the available houses for sale, and
really,
some really weird number. And it's like, well, those are the people that are going to get hosed, right? The investors in that company, the investors of the, that private real estate deal, that private placement, those esoteric investments that were never going to lose money because it always goes up, and so does crypto. And you know what I mean? Like all of that stuff, the average, I don't have any data for this, but I feel like the average homeowner, I mean, listen, if you're still holding on to a 5.5% mortgage, like, I don't know why, like, well, even at 5.5%, you've got a better deal than the going rate. So it seems like new buyers are screwed. It seems like anybody who wanted to refinance is screwed. Anybody who wanted to upgrade, maybe downgrade is okay. But from a consumer standpoint, it is kind of interesting though, that still the stock market low compared to recent numbers, but pretty much back to kind of that long-term trend line. If you kind of draw the that slope, we were way above it. Now we're back to it. So technically still kind of sort of there, but a lot of new investors in the last couple of years. But consumer confidence is as low as it's been since 2008. And that kind of goes back to what you were talking about earlier. Like, how could that be? Like, everybody's fully employed. You have, the consumer balance sheet is insanely good. Debt is going up, but it's still not that bad. It's like, I don't know.
People, to your point, Charlie Wise from Terry & Senior said that, hanging on to their mortgages. People are hanging, don't want to give up all that equity they've gotten over the past few years. I think it's dangerous. I think the big point here, OG, though, is this is so different that it's difficult to read something like this for me, because I don't want to try to call the bottom. Like, if I'm trying to call the bottom of this thing, I'm making a big mistake.
Well, we're exponentially closer to it.
Yeah.
That's the word I want to use. Infinitely closer. Infinitely closer.
Okay.
We're closer. How's that? We're closer to the bottom than we were,
2 months ago,
5 months ago, 2 months ago. No, I mean, we have to be.
That is a grass is half green. That's a grass is greener.
Glass is half
Hey,
full.
guys,
Glass
this
is
actually
half full.
talking about trying to call the bottom. This may be a good time. Check out this article that I bumped into online. I clicked on this because I thought it was something entirely different. The clickbait title was 10 hilarious bull and bear calls. So you know what I'm thinking I'm going to get is like roar, like with a question mark. I'm expecting like trained bears to be whatever noises bulls make, like the bulls. Right,
Bear call
exactly.
number 6 will
I
make you
open it up,
LOL.
boring. I'm like, oh, who would love this? Joe and OG. So check it out. There's no subtext there. I'm not trying to say anything else about it, but it just seems like the kind of article. But just check it out. Read it, scan it real fast, and see if it's relevant, it's pertinent, it's germane to the discussion that you're having right now.
Are you going to tell us what's in this thing or not?
It's 10 really bad bull market or bear market calls that people had where they were like screaming from the mountaintops about it's all going to end, or, oh, it's about to go to the sky. And, it didn't work out. But I kept scrolling all the way through. Like, maybe they're going to surprise me. Number one is going to be a cute little bull snorting and be hilarious. It wasn't.
Yeah, number 10 on this list, Dow 30,000 by 2008. OG, they might have missed that. Robert Zucaro, who is some of the...
Yes, but remember, no, just think about that. Remember how obscene that was? And it's where it is now. So yeah, he was off by a decade and a half, but it didn't seem like it when he said 30,000 by 2008, it was not like he'll probably be off by like 10 years or something. It was like, no, dude, that will never happen. It wasn't like it's going to happen. It was like that number will never, ever happen. And here we are all belly aching about it being at 30,000.
Being back at 38. So. Number 9, Paul Krugman, before he was a Nobel Prize winning economist, he made a bold statement about the internet, said that the internet would have no impact on investing, would have none.
I believe it. Sounds
How about
legit.
this one? November of 2000, Dow 36,000, the new strategy for profiting from the coming rise in the stock market, co-written by James Glassman and Kevin Hassett. If that name sounds familiar, it's because Hassett was one of Mitt Romney's main economic advisors when he campaigned for the presidency. Number 7, Netflix overvalued. Netflix ultimately ended up.
I was going to say that one.
I was gonna say, yeah, sounds right to me.
The bad news was this was 2003. Netflix still might be.
It's hard to imagine.
I clicked on an article from 2003.
No, Netflix overvalued. That the call was from Paul LaMonica in 2003.
Oh, thank God! I thought my internet was old.
Yes, he was fairly certain that Netflix was overvalued at. It was trading at $10.98 a share, and it was overvalued.
Yeah.
Imagine if you could get all the Netflix you wanted now at $10.98.
Yeah.
Wait long enough, you might be able to.
With ads.
Dow was gonna crash in 2018. We see this one all the time. AIG bullish on its credit default swaps back in 2000, headed into the 2008 crisis. Loving the AIG. Before the financial crisis. What else we got? Google IPO doesn't make any sense. Steve Ballmer saying the iPhone would not get significant market share. We did this on Monday as well, Doug. We had people wrong about technology, like Thomas Watson saying there would be no need for the home computer. Nobody's right. Like 5 people are going to want the home computer
and TVs. And
I think whenever we trust these people to be the guru for us, and we go, well, Elon Musk says, so it must be.
But wait a minute. Isn't that what we're hoping people think of us as?
Hopefully they think of us as the anti that.
We are their beacon. We are their guiding light.
The straight shooters.
How often have we had a call? We've called the ridiculousness of calls, and we've been right on those.
True.
But I don't recall us making a call yet.
We got this. Are you kidding me? We've got this whole make a plan, stick to your plan. That's as bold as it comes. You're out there on a skinny branch.
Yes, making a plan, the riskiest thing that you can do. And I think that's a good place to leave this. Take a risk, make a plan, forget trying to make the call. That's our call.
Sounds gutsy.